The main driving forces behind OPEC+, Saudi Arabia and Russia, have imposed drastic cuts, which are causing the price of crude oil to soar. The oil cartel's cuts, which were put in place to boost oil prices, have been incredibly effective, with barrel prices climbing by a staggering 30% since June. As a result of Russia and Saudi Arabia's recent announcement that they aim to continue the present voluntary production limits, prices are currently hovering ever closer to the $100 per barrel threshold and may perhaps transcend that revered and feared statistic. High oil prices have historically been beneficial for the oil industry even as they cause conflict in other industries. But this time, even for big oil, it might be too much of a good thing. While high oil prices can result in pure profit for the oil sector, there is a narrow line between stimulating and discouraging demand because of sticker shock in the market. High prices at the pump can also cause major drops in demand. For instance, gasoline consumption in the United States fell by 4.1% in June and July of last year, when oil prices averaged a sizzling $110 per barrel, compared to the same time frame the year before when oil was selling for $70 per barrel. The amount of the year-over-year demand gap also shrank as that $110 threshold did, highlighting the link between high oil costs and consumer caution. And this year, when American households are expected to be living on considerably tighter budgets and have much less savings to fall back on, the chilling effect could be even more pronounced. The average savings of U.S. households earning $50,000 to $100,000 annually have decreased by half, according to the Bank of America Institute. And when student loan installments resume the next month, representing nearly $100 billion a month on a national scale, that unsettling downward trend is going to get worse for millions more people. Unsurprisingly, there has been a lot of hand-wringing inside the Federal Reserve as a result of the rise in oil prices. Rising energy markets and gas station costs drove up inflation and robbed consumers of purchasing power in the United States in the mid-1970s, as well as the early 1980s and 1990s. As a result, recession worries are growing in tandem with oil benchmarks. According to Bloomberg this week, policymakers will be particularly on the lookout for an increase in inflation expectations caused by a spike in gasoline prices because they worry that could result in a more widespread rise in prices. According to Mark Zandi, chief economist of Moody's Analytics, the rise in oil prices is at the very top of my worries at this point. We're going to get terribly sick if anything costs more than $100 for any period of time. Furthermore, the oil sector is probably not immune to this disease. Although savings and household finances are fragile enough in the United States, as is customary, the full impact of consumer drawbacks will be seen in developing nations. Contrary to historical patterns, the US dollar's value has only risen in tandem with oil prices, placing a hard pressure on countries with weaker currencies and fewer cash flows but are nevertheless compelled to purchase oil priced in dollars. Due to the fact that these growing nations contain the enormous markets of China and India, this will have a significant effect on global energy and economic markets. Even while a price of $100 is not considerably different monetarily from, say, a price of $99 per barrel, three digits have a disproportionately large psychological impact on consumers and the energy industry as a whole. Therefore, crossing that boundary will send unproportional shockwaves across a stretched and vulnerable global market, for which the energy sector should be ready in the coming months. Fortunately, most scientists believe that the excursion into triple digits will be brief, although the harm done will probably last longer. According to Vortexa, the market hasn't yet fully absorbed the effects of Saudi Arabia's additional production cut, which might result in a significantly tighter market if the top crude oil producer in the world maintains low export levels. Saudi Arabia announced on Tuesday that its 1 million BPD reduction would continue through December. The action strengthens the precautionary efforts made by OPEC+ countries with the aim of supporting the stability and balance of oil markets, according to the kingdom. Additionally, Russia prolonged the end of 2023 for the 300,000 BPD export restriction. If Saudi Arabia keeps export levels as low as they were in September, David Weck, chief economist at Vortexa, wrote in a report this week, it might be able to tighten the market on its own in the fourth quarter, even without the assistance of other OPEC+ members. According to data from Vortexa, the Saudis reduced their shipments of crude and condensate in September by more than 1 million BPD in comparison to the average for 2022 and by 1.6 million BPD in comparison to the average for the first half of 2023. Russia's shipments are also thought to have decreased last month, though not as significantly as its September vow to cut 500,000 BPD implied. The best estimate provided by Vortexa for actual reductions in Russian shipments is 150,000 BPD. The market may believe that the Saudi cuts have not had a significant impact because Saudi arrivals at ports of destination have not altered significantly thus far. As long as barrels keep coming in, there is a risk that market players will ignore the full impact of Saudi/OPEC Plus reduction, according to Vortexa. As far as we can tell, demand indicators are not looking particularly bad, WEC continued, referring to the fourth quarter. Globally, the buffer against a potential supply shortage has been eroding as crude and product stocks have been drawing both onshore and offshore. Without dramatically tightening the market and driving prices well beyond the $100 per barrel threshold, it appears doubtful that Saudi Arabia can maintain production and export levels at the lows of October until the end of the year. In September, higher gas costs caused producer prices in the US to increase, adding to concerns that there is still a long way to go before inflation is controlled. In fact, given how volatile oil prices are right now, the plan is now really in doubt. According to data released this week by the Bureau of Labor Statistics, producer price inflation increased by 2.2% annually and 0.5% monthly in September. Price increases exceeded expectations. Fuel prices are to blame for the spike. In the reported month, gasoline prices alone increased by 5.4%, accounting for 40% of the overall price increase. This raises concerns about potential future Fed rate increases, which would in turn cast doubt on the prospects for the world's largest economy's ability to thrive. After yet another extension of the production restrictions Saudi Arabia and Russia put in place earlier in the year with the declared purpose of keeping the market balanced and the perceived goal of keeping prices higher, oil prices reached $90 per barrel in September. Meanwhile, the most recent outbreak of violence in the Middle East raised serious concerns about the security of the region's oil supply, causing prices to rise once more. However, due to the high level of uncertainty on whether the violence will extend across the Middle East and, if yes, how quickly, Saudi Arabia stated yesterday that it was collaborating with its regional allies to stop the unrest from escalating further and that it was dedicated to maintaining stable oil prices. This was presumably interpreted by the market as a promise to maintain the oil supply, since prices dropped. On the same day, Abdulaziz bin Salman of Riyadh and Alexander Novak of Moscow met, and Abdulaziz bin Salman indicated that Saudi Arabia and their OPEC Plus ally Russia would continue to limit oil production. Prices are still low for the time being, in part due to further dismal economic news, like Germany's declaration that its GDP will drop by 0.4% this year due to what Reuters dubbed persistent inflation. The ongoing inflation in that country shares the same causes as the high energy prices in the US. As a result of them, Germany expects its annualized inflation rate to be 6.1% this year. Even more pessimistic than before, the IMF predicts that Germany will decline by 0.5% this year. After producer prices moderated less than anticipated in September, price gyrations in the oil market could lead to future pressures on pipeline pricing. With negative supply shocks and annualized core PPI running considerably above policymakers' 2% inflation objective, the Fed will probably act cautiously. This is according to a Bloomberg economics analyst, who is speaking before today's consumer price inflation report is released. Analysts anticipate an annual inflation rate of 4.1% and a monthly increase of 0.3%, which is seen as a positive development and a sign of slowing inflation. However, these projections might also be exceeded by actual figures based on changes in producer prices. Additional rate increases would result from a higher than anticipated estimate on consumer inflation, which would be terrible news for the US economy on top of recent signals that the global market for US government debt may be saturated. In a dubious silver lining, such developments would be adverse for oil prices. In the meantime, the Middle East will continue to be in the news, and the big question is if there will be more regional engagement in the conflict in light of rumors that other Islamist organizations are endorsing Hamas and preparing to join the attacks against Israel. In fact, the most recent information from the conflict zone includes allegations of Hezbollah attacks on Israel from southern Lebanon and Israeli rocket fire in retaliation. According to the official statement, this indicates that Saudi Arabia's cooperation with regional and global partners will be quite difficult, sustaining the war premium on oil prices and lowering inflation expectations in important markets. What are your thoughts on Saudi Arabia and OPEC+, and do you think they can crash the US economy? Let me know down below. If you want to continue to learn about business investing and financial education, we have got this video waiting on the screen for you to check out. Don't forget to give this video a like and subscribe for more videos like this. Thank you so much for watching, and I'll see you in the next one.